May I invite Tarun to come and present his paper? His discussant is Renuka.
Thanks for giving me the graveyard shift, Susan. I appreciate it. No, you gave it to me and then I accepted it. That's it's not quite the same as me asking for it. But anyway, here I am, subjected to Susan's dictatorial preferences, and I'm going to try and entertain you in the last 20 minutes or so of this presentation slot. Thanks to all of you who have stuck around gamely for this presentation. I'm going to try and make sure that I emphasize the theoretical content and just hammer it home to you, because obviously that should be your reward for sticking around at this stage. So this is a paper that is joint work with two of my frequent co-authors, Pab Jyotikastira and Christian Lundblad from UNC, and Tanya Babina is a PhD student who's on the job market from UNC this year. And this is a little bit of a departure for all of us. So let me try and explain what the issues are that I'm thinking about. So taxes are obviously one of the most important levers of government policy, and there are different types of taxes, of course, that governments have. One of them is taxes on assets. Okay, so taxes on assets are usually and very often by governments used as an inducement to generate particular types of ownership. Okay, so in particular, tax exemption policies exist on certain asset classes to induce certain kinds of people to hold assets. So for example, in India, there are taxes on short-term capital gains, but none on longer-term capital gains to induce people to have longer holding period horizons in the main. In the US, state governments, and this is going to be the subject of this talk, provide exemptions for in-state domestic holdings of state debt. Of course, in-state holdings of debt is also something that national governments think about a lot. So it's often said that Japan and Italy don't have as bad of a debt problem as other countries do, even though they have very high debt to GDP ratios, because they have very high internal holdings of debt. So our paper tackles this topic pretty squarely. Now, the reason that taxes on assets are considered pretty good for governments is that there's a perception that these tax policies are revenue neutral. So let me try to explain that in a second. So what does that mean? So it's obviously the case that if you offer a tax exemption to a certain group of investors, their required rate of return that you have to pay them in order to induce them to hold the debt is lower to the extent of the tax privilege that you give them. But on the other hand, of course, you don't collect the tax from them, so the tax receipts are lower. And in fact, they offset each other perfectly. Okay? So in some sense, Ricardian equivalence holds by construction in this setting, right? Because the debt and tax consequences of the tax change, in some sense, it's a wash. Okay? Now, our point is that that's not really true. So that's precisely where our analysis comes in and says, look, there's a second order effect that might not be so second order that you want to consider when you're thinking about these issues. And that's really the big part of this. Okay? So to give away the punchline of the paper, it's very straightforward. What we say is, okay, what you're going to do is you're going to induce a certain group of people to hold your assets by giving them a tax exemption. Let's assume it's internal people relative to external people. What does that do? If the tax exemption is high enough, we're going to show you in a theoretical model, that what this means is that in equilibrium you get everybody who's internal holding your debt and no one who's external holding your debt. Now you might think that that's quite a good thing because you can negotiate with these people. Our point is it's not such a good thing because now you're held captive by this particular audience, and if they have constraints to their wealth, it's going to show up in the fact that there isn't risk sharing, they don't diversify. And if they don't diversify, then you get price impacts of supply. If demand shocks exist, there are problems for you. If there are wealth variations for this group, you're held captive to these people. And then think about it in extremis. If you had a bigger model, then what this would basically tell you is, at precisely the times that you want to raise more debt because you face an external shock of some sort, the people from whom you want to raise that debt, that is your internal group of people, their wealth is going to be low at precisely those times. So even in a state contingent sense, this is really a bad thing for you. It isn't a good thing. Okay? So that's really the point of the model, and then we show data from the US municipal bond market that basically confirms this result. Okay? So I'll quickly talk you through the model. I'll show you a few results, and then I'll let the discussant explain the paper. Okay? So, all right. So look, there's a lot of literature on this. Okay? People have found that taxes have a significant influence on portfolio allocation and investor decisions to allocate assets in various places. It turns out that there's very little evidence that there are consequences on asset valuation. Okay? So lots of people have said this in the past. Okay? Sparse evidence that taxes have any effects on asset prices, and then there's much about the effects of taxation on investment values that is yet to be understood, and so on and so forth. Perhaps the most famous formulation of this is by Miller. Okay, so the Modigliani-Miller proposition says that personal income taxes shouldn't matter. So if you go back to sort of, corporate finance 101, so Miller has this 1977 AFA presidential address where he says, debt supply should adjust such that all otherwise similar debts are priced by the same marginal investors, and then he makes this very famous statement that one clientele is good as another. If you remember this presidential address, for those of you who are old enough to remember this, it's probably like nobody in this room. I'm going to state that, Percy, just to make you feel much better about everything. But there's this famous statement in the paper that this is like a horse and rabbit stew, that the effective taxes on debt is like one big horse and one very small rabbit. In other words, it just doesn't show up in the pricing. Okay, that's what he says. Now, our point is that that's not right. Okay, so if you have arbitrage frictions, then this can be a problem. Okay, so tax policy in our paper will show you that it affects, first of all, ownership structure. It creates tax clienteles. That's pretty obvious. The second part is that if you've created tax clienteles, you've segmented the market. Okay, and then if you're a student of international asset pricing or international finance, you realize that market segmentation is not a good thing because you get imperfect risk sharing. This is like home bias. Okay, so what happens in a situation of home bias? If there are frictions to perfect arbitrage across these situations, there are going to be consequences for asset valuation and security issuance, and they'll have price impacts. Okay, that's the point of the paper. Okay, so the simple theory model basically takes two giants of the field and then bashes them together. So this is Miller meets Merton. Okay, so we have a sort of version of Merton's investor recognition hypothesis model, and then we have a Miller tax equilibrium. It's a very simple model. This is like baby corporate finance meets baby asset pricing. So all of you should be like really happy with this model and then use it. Okay, so I know all of you are going to go back and solve this model when you get home this evening, right? Okay, so that's really the point of this presentation. Right? Absolutely. All right, even after the graveyard slot. Okay, so what is the contribution? For corporate finance, we highlight a new cost of external finance that you want to consider your investor base. For international finance, we highlight a neglected issue for domestic sovereign debt holdings that maybe you want to worry about the composition of your investor base. Our empirical tests use the US municipal bond market as a laboratory and then confirms the model's predictions. Okay, and why is the US municipal bond market a good one? Because every state has its own tax exemption policies where it exempts in-state holders very often from in-state taxes on municipal debt. These tax privileges can be as high as 13% in some cases. Okay, so it's pretty significant variation. Okay, so let's take a look at what this means for the US municipal bond market. Okay, so all US municipal bonds exempt their holders from federal income tax. In most cases, this exemption also extends to state income tax and even city income tax for in-state holders of the debt. Okay, so just consider these 4 municipal bonds, and these are the policies. So if you're a holder who's a resident of California, you have a 13% state income tax. Okay, you're exempt on your holdings of municipal bonds from federal income tax, so that's good. And then the CA bond, if you're holding a California bond, you get exempt from the state income tax as well. Okay? So relative to your holding of, for example, a North Carolina bond, you prefer to hold this one because you get a 13% tax exemption on this one relative to that one. Okay? Again, on Illinois bonds and Texas bonds, you're also getting taxed. Okay? The North Carolina bonds, for example, okay, if you have a North Carolina resident, you have a 6% in-state tax, you're exempt if you're holding North Carolina bonds, but you get taxed on all of these. Okay? Similarly, if you go down all the way, you start to see that there are differences. So in Texas, you have a 0% state tax rate. So in fact, every bond is equivalent, even though you're exempt from in-state corporate taxes. So any difference in difference specification we do is going to work across these exemption policies. So there are 2 components to the exemption policy. One is how high is your in-state tax rate, and second, do you offer an exemption for your in-state holdings of debt? And you multiply those 2 things, you get the tax privilege that you have, and that is effectively what's going to segment the market. So the first step in our empirical analysis is going to show you that it does segment the market. So bonds that have high exemption policies and high in-state tax rates, we're going to show you are disproportionately held by in-state municipal bond funds. Those that don't have these policies are actually generally held by national diversified funds. And then we're going to show you a few empirical results about that. Okay. Now, so there's this quasi-exogenous cross-state variation. Turns out that the tax privileges hardly change over our sample. It does change very significantly for one state over our sample, Florida. And so what we do is a before and after analysis for Florida to check whether our results apply when there's a big exemption for Florida and then don't apply when the exemption goes away. And we find that that is the case. Okay, so that's quite reassuring for us. So there are some changes in the sample, When we find them, we find that our results are there and they're not there. Okay. So what's the point? Point is, in California, bonds should be held mostly by California residents because of the tax policy. In Texas, bonds are mostly held by out-of-state residents, okay? And then the consequences implied by the model will follow. So what are these consequences, okay? I'll get back to these preview of the results and all of that after I show you what's going to happen in the model. So let me tell you a little bit about the theory, okay? So it's a really simple model. So let me just tell you about the asset structure. I'll just set up the model for you, and then I'll take you straight to the results. The asset structure is very simple. There are two assets, a little in-state asset and a big global asset. That's what we model right now. The global asset just has an average rate of return, which we'll solve for in equilibrium, and it's driven by some risk factor. The inside asset is driven by exactly the same risk factor, has some equilibrium rate of return. The only difference is it has a bit of idiosyncratic risk, okay? Now, obviously, you can diversify that away by just combining it in the appropriate proportion. It's going to go away because it's all driven. There's only one source of systematic risk. But the entire point of the model is that some guys are induced to hold this asset because of these tax privilege policies. So what are these investors? There's an inside investor and a global investor. Inside investor has wealth that's much lower than that of the global investor, okay? Forget about this for a second, all right? So what do? They just maximize the same mean variance utility function. It's really simple. So they just maximize the expected return on their entire portfolio holdings subject to a variance penalty. And then this is the arbitrage constraint. It's a short sales constraint, okay? So you can't short the debt of either asset. You need that friction in order for all these effects to go through. You could have other arbitrage frictions, in which case the result would go through as well. But that's important. Okay. Solve for asset holdings but you basically do portfolio choice, and then you solve clear markets. And if you clear markets, forget about all this, this is what you get. Okay? So this is basically the model. All right? So what is this? This is the quantity of the asset, and this is the expected return of the asset, which is the inverse of the price. So this is like demand and supply for the asset in equilibrium. So it's very straightforward. The higher the tax privilege tau that you offer for your in-state residents, there's a big region which has basically upward sloping and expected returns. What is that? That's like downward sloping demand for the asset. Okay? And then once you get into region 2, where the asset equilibrium rate of return is the same as that of the market asset, then you get all these global investors coming in, and you have basically a flat aggregate demand curve for the asset, so you can issue as much as you want. You know, demand can move around, and nothing is going to happen to the price of the asset. The problems lie when you get into region 1. Okay? So what happens in region 1? You're held captive by your local audience, and if you're held captive by your local audience, let's assume that they have a demand shock. If they have a demand shock, what's going to happen? The demand curve is going to move to the right. If the demand curve moves to the right here, the price or the expected return of the asset is going to move around. Here, if the demand curve moves to the right, nothing happens. Okay? So this is asset supply. If you move supply around in this region, move your supply curve around, you're going to get price impact because the expected rate of return is going to move. Over here, you move that around, nothing happens to the equilibrium rate of return. Okay? So that's the entire point. Okay? Point is, supply moves around, demand moves around, or idiosyncratic risk moves around. In this period, you get big price impacts. What does that mean? If you're the state government, you're in a state where everybody's held captive, you start issuing lots of debt, it becomes more and more costly the more debt you issue. Okay? That's the point of the model. Okay? So the model basically makes that very clear. Okay, now I've got about 5 or 6 minutes. So I'm just going to show you, first of all, that there are tax clienteles, and then I'm going to show you that there are some effects on prices and capital raising. Okay? So the first thing I should tell you is that we use municipal bond funds to do all of our tests. Okay? This is just to show you what the aggregate holding of these municipal bonds has looked like from 1998 to 2014. Okay? So these guys hold about 25% of the market on aggregate. Okay? And we have all of the data there. All right? That's basically it. Okay. Now, what are we going to show you here? There are 3 types of municipal bond funds: state funds, national funds, and high yield funds. If you're a state which has no privilege for its in-state residents, we're going to show that you're primarily held by national diversified funds. If, on the other hand, you're a state like California, which has a high state tax rate and tax exemptions for local investors, we're going to show you that you're mostly held by California funds. Okay? And then the assumption that we're making, which should bias against us if it isn't actually working right, is that these holdings of the municipal bonds that we can see are going to be very similar to the other part of the holdings that we can't see. Okay, and even if we can, if we could see it, we'd probably get better identification. Okay. So, who holds state funds? I'm going to show you something from a prospectus. This is Vanguard California Intermediate Term Tax Exempt Fund. Okay, what does it say? It says this municipal bond fund seeks to provide federally tax exempt, everyone's federally tax exempt, and California state tax exempt income, and typically appeals to investors in higher tax brackets who reside in California. Okay, so they're marketing themselves as such, and these are the guys that should be holding your debt if our theory is correct. Okay, and that's precisely what we find. So when we take all of these municipal bond funds and then look at the ones that have very high tax privilege, if you look at the fund holdings of in-state funds, 50% of your total assets are being held in total. And then across the maturity spectrum, about 35% of 0 to 7 year maturity bonds, municipal bonds issued by these states, is held by state funds. And then as you move up the maturity spectrum, it goes up to 58%. Whereas if I look at states that have very little tax privilege, notice the fact that the state fund holding is substantially lower at 15%. Okay? So 85% is being held by nationally diversified funds. These differences are strongly statistically significant at any level of significance. It also increases again across the maturity spectrum here. Okay, so that's basically the point. So first prediction of the model is you should get more home bias in states that have a higher tax privilege. That you get that one, pretty easily, and that's precisely what you see in the data. So that's good news. All right. Now the next bit is what happens to prices and what happens to capital raising. So our model says that if you're in a state which has a very high tax exemption for its in-state residents, what happens? You're held captive in some sense by this investor base. And so if you're issuing debt, or if they have a demand shock, okay, or if there's additional idiosyncratic risk in those states, then all of those things should show up more in these states in which you're held captive. So in some sense, your debt becomes more volatile because you're held captive by this audience. That's the prediction of the model. So that's precisely what we try to look at. We look at the spread of 20-year bonds or short-term bonds, and we do different tests over the paper, but I'm just going to show you that for 20-year bonds over treasuries, okay? And this is just local idiosyncratic risk, demand shocks, and then changes in supply, okay? And then what we do is we just ask the question, okay, first of all, are these effects greater for states with concentrated ownership? And that's the interaction that our model predicts, okay? So that's all we're doing. At this stage, this is a pretty early version of the paper. We're not doing anything fancy like structural estimation, but we could. We do a little calibration just to make sure that equilibrium ends up in region 1, which it does. We sort of show this in the paper. Okay, so the basic point is, okay, that yes, okay, so the first thing we look at is what happens if there's local political risk. So close gubernatorial elections is what we look at. Okay, so B is really what you want to look at, which is high state fund holdings interacted with high privilege, tax privilege. Okay, and then for those states, when you have a close election, what happens? You get a pretty significant pricing effect. That pricing effect actually gets much bigger when you have a state that has low wealth relative to very high issuance. Okay, so the effect is about 20 basis points more in years when you have in months around a close election. Okay, so these effects are concentrated among states with high state fund holdings and high debt to high tax income ratios. Okay, so remember the effects are going to get bigger when you have very little wealth that's local, as well as have a big supply that these guys need to absorb of debt. Okay, demand variation shows up very similarly. Okay, so these are basically the predictions of the model. B times lots of debt pressure, which is people selling out of mutual bond funds. And then here again, that shows up in the interaction specification. And then the third thing, which is perhaps the most important one, is suppose I look at supply, which is suppose the state decides to issue more debt. What happens? It turns out if you're in a state which has very high tax privilege policies, then it is a 50 basis point higher cost that you pay for every unit of debt that you issue. And this is especially true in states when you have very, very high debt relative to income in the state available to absorb that. So the total effect is 75 basis points higher, which is pretty substantial. Okay, so this is a big effect, especially on the supply side. Okay, so we do 2 experiments. I've got about a minute, so I'll just tell you about these experiments. So in one case, there's a reallocation of the short end. So after the financial crisis, one of the things that happens is money market funds collapsed right after Lehman. Okay, I don't know if you know this, but the buck was broken, and so, okay. One of the things that they did is they fled to municipal bond funds, especially at the short end. This is a little known fact. We discovered this using our data. So we view this as a pretty exogenous shock to ownership structure at the short end. And so now what's happening is there's a bunch of national money coming into the short end. So if our model is correct, all the pricing effects that we see should only persist at the long end of the term structure rather than the short end, where the ownership is now pretty much diversified, kind of exogenously because of the buck breaking. Okay? And that's precisely what we find. The pricing effects disappear for 5-year munis and lower, and remain the same for 20-year munis and higher. So at the long end of the term structure, there's big effects. That's what it looks like for long-term bond funds. This is what it looks like for short-term bond funds. So this is, we look at before versus after here and before versus after here. All the pricing effects still exist here, don't exist here. Second thing I already told you about what happens to Florida after this tax exemption goes away. We find the effects, okay, before, we don't find them after. Okay? So the final thing that I'll tell you is that capital raising is higher. Okay, we do a little differentiation between different types of bonds, but I'm not going to go into that because I'm pretty much out of time. Let me just conclude. Okay, so what do? We use municipal bonds as a natural experiment, well, a sort of good laboratory to analyze these questions about taxes, home bias, and pricing. Okay, and so what we basically find is states whose munis are mostly owned by in-state residents, like the model predicts, have limited cross-state risk sharing. There's a higher sensitivity of these bond prices to variation in demand and supply and local political risk. And then what I didn't show you, but I've just told you, is that they also have difficulties raising capital for public projects in stress periods. Okay? So the implications of the model exist for more broadly for asset pricing and corporate finance. So I'm looking forward to the discussion. Thanks for being patient and listening to a theory paper with a little bit of empirics at the end of the day. Thanks.
Thanks, Tarun, for a very interesting paper. I have just a few comments, some in terms of methodology and some in terms of what this implies for how we think about issuance of bonds. So let me just get to that. So just to set the context, and I think you did that in your presentation as well. We began life in a neoclassical world where we said that the only thing that mattered were the facts about the security. Then came behavioral finance, and we said that individuals made mistakes, but this was costly for them. And the trading by the others would sort of wash out the effects, and the only persons who would suffer are the people who are making the mistakes themselves, who have behavioral bugs. In terms of institutions as well, we said that there are principal agent problems in institutions, and so if managers make mistakes, then again, it is costly for the institutions, right? There is absolutely none of these behavioral bugs have implications for asset prices. But now here comes this new strand of literature that says that not only are these mistakes costly for the agents themselves, they actually bubble up to asset prices. And I think that's a very interesting way forward for this research to go. So key takeaways from this paper are that there is ownership segmentation, and this ownership segmentation can have implications for risk sharing. And tax policy can actually push certain assets in the downward sloping portion of the aggregate demand curve. So, I'd said this again, I mean, you did mention home bias, but I'd said this in the literature of the home bias as well, where we say we've always known that there is home bias. And we've known that home bias affects the cost of capital. And we've known that home bias is driven by both information as well as familiarity. And now on top of that, you have home bias being driven by tax policy. So another lever that drives home bias is something that is relatively new. And I think that's very, very interesting. So my comments on the methodology, I just have two brief comments on the empirics. One is that, from this graph, you feel that there has been a shift in terms of the holdings of the diversified funds versus the state funds, while the number of funds has stayed roughly the same. So clearly there's some shift happening there. And does this explain some of the results that you see? And it might be worth, in some of the robustness checks that you do, worth exploring this a little bit more. On the empirical methodology, I because we are not familiar with the US, so whenever I think of, let's say, state issuing bonds, and I think of a Maharashtra and a Bihar in India, I'm sure that there are variations within the states in the US, and it would be nice to get a sense of what these state finances look like and what kind of issuance do you see by the states. For example, so there are differences in the debt to GDP ratios in the summary statistics. They vary from 12.81 to 23, or there are variations in the net issuance on the debt, which also varies. So there's a lot of variation, and maybe a little bit more of the context of where this variation is coming from would help. There was a paper that in this context, I read in the JFE, which said that in the equity markets, home bias happens because sometimes those companies are the only game in town. And considering the variation in state finances in the US, maybe there is some link here that it might be useful to explore, though I'm not sure you'll see anything, but perhaps just explore. I know you use controls for the regressions, but do you worry about common support in those regressions? Also, do you control for when the bond is issued? There are those regressions on close elections. Do we know if bond issuance increases or decreases during those times? And maybe there's some story there as well. And finally, on the interaction terms in the DID regressions, I know, for example, effects are concentrated when it's a high debt, high tax income. There's the triple interaction that you're seeing there. But it would be nice if we just got the coefficient on the high privilege, because then I can interpret that differential in the interaction term a little better. So maybe it's just that you're not reporting this in those tables, so it would be useful for you to report those as well. So that's just a few things on the methodology. Now I come to the implications, and I think that's the more interesting part. And perhaps that's where you can do some more extensions to your model as well. So, this has implications really for tax policy, right? So we want to combat home bias, and a government is better off if it has a diversified pool of investors. And how do we think of tax policy in light of the results of this paper? So in the tax literature, there is this issue of residence-based taxation versus source-based taxation. And do these results say something to us about how residence-based taxation is perhaps better than source-based taxation? And in India, we don't do residence-based taxation, but perhaps we should, because it combats home bias. Secondly, I think this has very interesting implications for disclosure policy as well. So far, we don't know anything about ownership of securities, right? And we never think about ownership of securities because it doesn't matter. But this paper is sort of saying to us that ownership details matter for asset prices, okay? And if they do matter for asset prices, how do we think about disclosures around ownership? And I think that's a very interesting question which may flow from this paper, and something that in the policy world we all ought to think about. And finally, there are questions around institutional issues. So I think, at least to my mind, it's the first time I sort of thought and read about how should the issuer of the bond think about these things, right? So, so far, most of the literature has only focused on what happens to the investor. Right? So the investor's making mistakes, and so the investor's suffering, and it's all from the point of view of the investor. But now I think it's sort of waking us up to the point that we also have to think about these things from the point of view of the issuer. And if you are Government of India, or if you are a state government, or if you are PDMA, then how do we start thinking about what pool of investors we want when we are issuing those bonds? And I think that, your paper sort of raises that question very neatly, and maybe if you could follow that up with more extensions, that would be wonderful. Thank you.
In terms of thinking about how the issuer, and so let's say state government should sort of trade off these things, and so the way I understand is the interest on like muni bonds would be taxed in the state where the investor resides, correct? And so in any case, if the issuing state issues a taxable, or its taxable bond, then if the investor resides out of the state, then tax receipts are gone anyway. So then the issuing state perhaps has to offer a higher interest rate to compensate for the tax, but the tax receipts are going to some other state. And so how should the state sort of trade these two things off?
Ajesha? And
Tarun, it's a really nice paper. It's a really important paper. I have to confess that if you had not been here in the graveyard shift, I would likely have never read it because it contains the word Munis in the title. Okay, and there's a very large fraction of this world that just tunes out the moment you say municipal bonds. But that idea is actually more general. The idea is perfectly scalable. So why not pitch this as at a bigger level and then say I happen to have a laboratory which is generating interesting data. To follow up on what Renuka said, I was just thinking, if you write this as an international finance paper, then the first thing that leaped out to me was that it is so interesting that the OECD model tax treaty, which is by and large used by all OECD countries, rules out some of the things that are found in United States states. So it is so interesting that amongst the OECD, they seem to have a universal multilateral disarmament treaty, which in my opinion makes a lot of sense, and particularly in the light of your results. Okay, there is an attempt at creating an open market and creating cross-border capital flows, and it would be counterproductive for any one sovereign to behave in certain wonky ways. And it also makes me wonder that should a federal republic like India or the United States also think of similar multilateral disarmament treaties, because this is just so harmful. This is so self-harmful for everybody concerned. So I'm just saying you could riff around these themes and turn it into an interesting economics paper that every economist in the world ought to read, not just some obscure guys doing municipal bonds.
Yesha, Percy, and then Alok. Oh, sorry. Yesha, can you please use the mic?
Sure, sorry. So one thing I wanted to ask was, can you see any characteristic pattern differentiating the states that offer this exemption and those that don't? In particular, are there any economic characteristics that define the states that are needing recourse to using this strategy as a way of generating financing? So you talked about California, and California went through a huge budget crisis, right? So in that context, if you have this kind of sort of economic need to generate a captive audience, maybe there is some impact from those economic characteristics in relation to the effects that you're seeing. And the other question is, I was wondering if you've looked at municipal insurers of bonds like AMBAC and MBIA, and whether or not they are also pricing in these differentiating characteristics into the price they're offering, and also the CDS market in this regard.
Oh, can we please get a mic to the back?
I found your paper so fascinating that I'm breaking my self-denying ordinance of not speaking during this conference. But it reminded me of a conversation I had with Mario Draghi about 2 or 3 years ago on the whole issue of Italian bond issuance. It seems to me that as a follow-up of your paper and as a follow-up to what Ajay has said, it'd be fascinating to do a study of Italian bond issuance, asset price movements, and coupons when Italy was issuing lira bonds as opposed to euro bonds, and what happened as a result. And, when I asked Mario whether he'd seen any work on this, he said no, but he'd asked some people in the Bank of Italy to do it, but I haven't seen it yet. But it'd be very interesting, just as not only just an experiment, but as a sort of a knowledge formation thing. And it might be useful for examples in developing countries, when we were dealing with the debt crises in Latin America, etc., where they've changed their currency several times, what the experience would be for emerging markets issuing bonds either in foreign currencies or local currencies, and what the implications might be for the issuer. Yeah?
So, kind of building on Ajay and Yesha's point, so I think the intuition in some ways relate to this corporate finance literature and relationship lending, and the idea there is you have these firms which have soft information, so they lend from one borrower, and if your borrower is hit, you are hit as well because your ability to raise debt. So it's kind of a similar stuff. And so, are there differences in these states that are tax exempt? So maybe they are swing states to begin with. They generally have more instability. Is there some differences in the information content about the kind of debt these guys raise versus others? the use of maybe the use of debt as well. So
Just to add further to what he was mentioning, are these bonds secured bonds or do they become bad also? Or is it government guaranteed bonds? So then the rate on, and secondly is, we're talking about the coupon interest. What about capital gains? If I'm someone from outside the state, is it coupon only which is taxed or capital gains also are taxed? Because that could make a difference. I could just buy and sell those securities and not pay tax.
Thanks. Tarun, would you like to take the question?
Thanks, that's great. Okay. Wow, so thanks very much for all of these comments. I'm glad that people seem to like the paper and have arisen from their slumbers. This is wonderful. So a couple of questions. So Prachi and Yesha both asked questions about, are there differentiating factors between these states? What is the trade-off between issuing to your own guys or issuing outside, and so on and so forth. One of the things that we don't do in our model, which is actually the next logical step, so we've seen lots of comments about this, is to endogenize government policy in this setup. Now, our implicit assumption, and we say this in the introduction, and having spoken to lots of state government officials, they seem to perceive debt issuance as, these tax policies as revenue neutral. Okay? So in some sense, they don't seem to be explicitly considering the second order trade-off that we're talking about, that we actually show is empirically quite important. But you might well ask the question, suppose there's a government that's optimizing its tax policy and is setting supply optimally. What is the situation for those states? And is it the case that you would see particular kinds of tax policies and supply in those states? We haven't solved that version of the model, but we should. In terms of empirical differentiating factors between these states, there isn't that much. I mean, the top tercile and the bottom tercile are pretty evenly balanced in a lot of different dimensions. And we have state fixed effects in our specification. So everything is being driven by state cross privilege in some sense, and then cross time, because there are all these shocks that happen at different points in time. And that's where the identification is coming from. We also could solve a two-state version of the model, because right now we have a single state and the globe. And so one question that you might ask is, if there are two states which offer exemptions for in-state but no exemption for out-of-state, do you get a corner solution? And the answer is you won't, okay? Because the intuition should be that you're going to trade off the tax privilege against the diversification benefit that you get from investing in the other state. So you'll get some home bias, but you won't get a corner solution, okay? So then there's going to be a more interesting trade-off to consider. We haven't looked at that in this version of the model. Ajay, we've tried in this new version of the paper that we've rewritten to pitch it more broadly in precisely that fashion. And in fact, the three of us are international finance guys, and that's precisely where this project started. You might be right. The thing about that is that one of the nice things about looking at the US state market is you don't have the usual currency considerations that plague international finance studies. That having been said, Percy made an excellent point. We've been looking for some kind of friction that would cause in-state guys in certain countries to hold their own debt, and you've offered us a really excellent friction, which is home currency versus foreign currency issuance. Because that's an implicit tax on outside people because they've got a hedge. And in some sense, if you issue tons of home currency debt, you're going to get into the same world that we have here. And it wouldn't be too hard to model that. And certainly in a follow-up paper, we could look at that. And that's something that we've been hoping to look at, but we haven't found the pegs. So thanks very much. That's a really useful point. I had seen this about, I thought it was a really great point that Renika made about the source country versus residence taxation. So that's something that we could absolutely look at, and we haven't actually looked at that in what we're doing here. As far as insurance is concerned, we've looked at the insured versus uninsured bonds. We find them mostly in the uninsured relative to the insured bonds. So, but we haven't looked at the CDS market yet, so we could look at that. Okay, what else did we have? Yeah, so we had a couple of other points. So your question was about default, and the answer is that there have been several defaults. There are two very big defaults that have been going on recently. One is Detroit, you probably heard about this, and the other one is Puerto Rico. Puerto Rico is ongoing right now. So these are both very interesting because in both cases, one simple consequence in our model is that a very easy way to get around this whole problem is to just eliminate the tax exemption. As soon as you eliminate the tax exemption, you get everyone. Another way to say this is, suppose I went and issued in a foreign currency, I immediately get a much bigger base, I get more diversification in my investor base, and then I solve all of these problems, okay? Now, of course, there's a question here about what's the trade-off that these governments are facing. Why do they give tax exemption? The question that our paper raises is, why do you ever want to give tax exemptions to guys who are in state? Okay, and so there may be considerations that are outside of our model that we might think of. Now, of course, it is revenue neutral, and even from the perspective of the individual investor, okay, it might be perceived as being revenue neutral because you don't have to pay the tax on the thing, but at the same time, you're getting a lower rate of return on the bond. Now, it's a little dinky to kind of assume that somehow they get bribed by this, they don't see that, or you could come up with some informational friction where they only look at the sticker price and they don't think about the tax that they have to pay at some point in the future. That's all a little hokey. So I think we've got to think a little harder about why states do this in the first place. Okay, so maybe if I had the benefit of having conversations with Mario Draghi, I probably would try to do that, but I might come and pick your brain about that. To Shashwat's point about relationship lending, I think our model sort of just makes a more general point. It's just that when corporate finance people think about issuance, they don't normally think about risk-sharing issues, which is what asset pricing guys think about. So in some sense, this is just a crossover paper. What this is saying is if you want to think about external finance, there are lots of things that people have thought about in the past. So information production is an asymmetric information point. There's moral hazard points about there's agency cost models of debt. Our point is that there's just another bit of this puzzle, which is that if you think about asset pricing, you think about risk sharing. If you think about risk sharing, then immediately you get all the consequences from our model. But most guys who think about corporate finance don't think about that issue. And that's really the point that we're trying to make in the paper. All right, thanks very much. Great.
Okay, it's that time of the day, of the year. I get to close another really cool conference, cool in my head because I really had fun through all the 3 days. This year has been particularly pleasant because we had so much market microstructure work, and that's something that I really enjoy. But even the other papers that have come, every year I learn something new, and this year has not been very different. So thanks to everyone who sent us papers, thanks to all the people who made time to come out and speak. And Pradeep and Yesha, you clapped when Renuka finished her discussion presentation, but typically through this conference, we have not applauded for the discussants. And I think the discussants are the real backbone, to a certain extent, to every presentation, because they take the trouble of reading it, sometimes summarizing it, and they pick out all the bones, and it's very cool. So just for that, right now, can we give applause to all the discussants of the conference? Okay, one of the things that I thought that I would mention this year, and I sometimes forget, but I should not, particularly in India, because I think that research of this nature is so difficult to do, right? It's difficult to do, it's difficult to get people to invest, to put time and effort and heart into this, which is what makes the research work. And India is not particularly friendly to funding this kind of research, especially when it's law, it's economics or finance, and law and economics. Somewhat, everybody considers this somewhat esoteric. So I think that it's spectacular that every year is this the 6th year? Yeah, this is the 6th year, and 6 years we've had people out in the industry who funded this conference. This does not come from IGIDR funding. We go out and ask people for money to run this conference, which is very esoteric, with models presented in the graveyard shift. I mean, how much more esoteric can you get, right? And yet people put up money for this. And so I would like to take time off to thank all of our sponsors. We've had 2 sponsors who've been steady sponsors, big sponsors every single year. And that is the 2 exchanges. They may compete with each other, but they contribute to this conference equally. And that's the NSC and the BSc. Thank you very much. NSDL this year has also been a sponsor. PayPal is a new sponsor for us. Phillips Capital is another new sponsor. Goldman Sachs was in last year. They came in with money again this year. And it's a great pleasure to have new funding, old funding, any funding, because it's a struggle sometimes to convince people that this is worth it. So I would like to thank all our sponsors. This happens every year. I have to stand up and say, this conference doesn't run without the people who actually coordinate everything. Personally, I don't do anything in this stuff. I just look at the papers and say, there's a research committee that puts together the selected papers. But there are 2 people. One person has been doing it by herself all these years, and she's been so exhausted that we decided to get another person to help her out with it. So you all know Jyoti Manke. Jyoti, please stand up. And this year we have Unnati, who's helped her with the conference. And of course, I've got my IT team who also is critical to making some of the stuff work. And I think Manish okay, this year it's Manish, and he's not around, but right. And Anurag is in the corner, who is a researcher, does cool things in addition to helping us with this conference, right? So, the new thing in this conference was the interface, or we gave up 1/2 day for something which is not researchy or esoteric, maybe esoteric, I don't know. So iSpirit helped us put together this entire fintech session, which I think for all the times that I've sent out emails saying that there's this nice conference that's happening, please come for it. I've never had so many people sending back regrets saying that, we regret we're not going to be able to make it to your conference because we would have loved to have attended the fintech session. But I think that was really a nice thing. I'd like to get feedback from all of you saying how well it worked. But being in India, it's great to be able to engage people from policy and industry and to see what's new and happening. And I think that has worked very well. And for this, I also have to thank one person, who I usually never thank. Ajay helped a great deal in putting this entire thing together. So, round of applause for him. And another thing that I rarely do is be a little sentimental, but for the last 5 conferences, we've had Gangadhar Darba come in on these conferences. And he's a quirky guy, and I think that he would have appreciated that we gave him mention. He's no longer here, but he used to enjoy this stuff very well. And he would have enjoyed the fact that we mentioned him at the end of this conference. So for Gangadhar. And finally, I have the pleasure of announcing the dates for the 7th Emerging Markets Finance Conference. Assuming that we get funding for the 7th Emerging Markets Conference, the dates are 15th, 16th, 17th December 2016. I hope to see you there. I hope that we get as spectacular papers and we have as much fun. At least I have as much fun as I have had. Thank you very much. See you next year.
Big round of applause to Susan, who has been doing this for the last 6 years. And every year I've attended at least four or five of them, and every year I see a progression in quality. And this year you brought together all the policy, and every year you bring together policy people, but this year you particularly brought together policy people and research, and I think it's been a fantastic job. You've done a fantastic job.